So good evening, ladies and gentlemen. Good evening.
Good evening, sir.
Thank you very much, Meshach and Jeff. Good evening.
Good evening.
Right. Now, if you remember, I hope you have read that Excel for the last class. Do you? Do you have it? Because if
Yes,
you remember, there is a question which we had not completed on, yeah? And,
exactly.
that is this question on the net present value on NPV. You know where we had done part A of the question, then we just started on part B, yeah?
Yes.
And in part B, what we were doing is determining what we had called the relevant cash flows over the project period. Now, if you remember, we had listed a number, yeah, of cash flows beginning with this which we had called the initial investment, all the way to the point we had that incremental fixed cost. And I did say that we are not yet done, because apart from these ones, we have more cash flows to then consider, yeah? And so, which cash flows are these ones? Let's come back to note number, let's look at note number. I think we had looked at all the way to note number 3. Can we now look at note number 4? And what does the question say in note number 4? The question says that the company is, excuse me, so the company is eligible for capital allowances. This is what in a simple term, you can call depreciation for taxation purposes. Remember, at the rate of 25% on reducing balance. Allow me to explain that when we talk of a capital allowance, this is not a cash flow per se. You know, just like depreciation is not a cash flow, even a capital allowance is not a cash flow. But the fact that the question provides it means that we need it to then compute something thereafter. What it is we are to compute thereafter, let's compute it once we have determined now this capital allowance. So again, you'll come down here under the workings. You know, we had working 1 all the way to working what, 5. Let's have working number 6. Number 6 we are saying is the capital allowance. The question says that we grant this. Remember, at the rate of what percent? The rate is 25% on reducing balance. And normally, you know, normally when we talk of capital allowance, what is this? This is the allowance that you grant on the assets you use to run your business. And it's that allowance that you grant, remember, instead of depreciation expenditure. We do not allow for depreciation for tax. So instead of depreciation, KRA allows for what we call capital allowance. And so when you want to compute this, you then compute it for the first year. You then compute it on the cost of the asset brought forward. So what is the cost of these assets are brought forward? Remember that the cost of the asset was how much money? When you come back to this relevant cash flow workings, you know, we already said that we have the initial investment. And that initial investment totaled 100 million shillings. You know, the initial investment is then the value at which you acquire the machine or the asset that you want to use. So the cost of the asset is therefore that initial investment of 100 what? 100 million. So I will come down here and say that at the start of period 1, you know, you provide that from period 1, yeah? The cost of the asset, we have 100 million. So the cost of the asset, we have 100 million. On this 100 million, we can then provide for capital allowance. And the question says that we provide for it at the rate of 25%. And that will mean that you take the cost of 100 million, multiply this by 25%, multiply that by 25%. That means that the capital allowance period 1, we then have 25 million. And I want somebody to remind us, if I take capital allowance, or if I take the cost brought forward, I minus this capital allowance, you know, down here, the brought forward cost, 100 million minus this 25 million, this gives us about 75 million, meaning by the end of period 1, the value of the asset will have reduced to 75 million. Cost of an asset, if you minus capital allowance, what do you call that figure? When you take the cost of an asset, you minus capital allowance, what do you call that figure in taxation? Huh? Who is remembering what you call it? This difference is the difference is what you call the written down value, WDV. So written down value, and I hope with that you now remember. Meshach, do you now remember the written down value?
Yeah, now I remember.
Yeah, so that's what you call the written down value. So when you come to period 2, and we can call this the written down value, remember carried forward. It is this written down value that you carry forward in period 1 that you then start period 2 with. When I now come to period 2, the value of the asset brought forward, we then have 75 million. So we just copy that 75 from period 1. All right. So using that procedure, we should then be computing this all the way to the last year. And how do we go about computing this all the way to the last year? Now, you don't need to compute one by one all the way to the last year. You can use a shortcut to get all the figures to the last year. What is this shortcut? Once you have done it to this brought forward figure, period 2, what you can do is simple. Can you highlight this 75 and then just drag the formula to the last year? Again, highlight this 25 for year 1, drag it to the last year. And then lastly, highlight this 75, also drag it to the last year. That way, you then have all the figures at once. And let me have a confirmation that you have been able to do that. Let me talk to Abdi. Abdi, have you been able to do that? Abdi, have you been able to do that? Meshach confirms that he has gotten that. What about Abdi? And what about Jeff? Jeff, have you been able to do that?
Yes.
All right, so thank you very much. Now, let's agree on one more thing. At the start of period 1, you know the value of the asset is these are 100 million. As we grant capital allowances across the 5 years, you know the value of the asset keeps what? Reducing. And the 100 million reduces all the way to at the end of year 5, when the value of the asset is now that 23 million. What this means is very simple. At the end of the last year, we are now valuing the asset for 23 million. Now let's not forget that this asset has to be what? Sold. At the end of the project, the asset is what? Sold. The value at which you sell the asset we had agreed, yeah, is this value which we call the residual what? Residual value. So that 20 million. So we want to sell the asset at the end of year 5 for a value of 20 million, when we are valuing the asset at 23 million. So if we are selling for 20, when the valuation is 23, are we profiting or are we losing on this sale? Somebody. Are we profiting or are we losing on this sale? Somebody?
We are losing.
Yeah, we are losing on this what? On this sale. So the next thing to compute as working number 7 is then the disposal what? Is then the disposal loss. Is then the disposal loss. Remember in accounting, when you sell an asset, you call that disposal. So we are looking for the disposal what? Loss. We determine the disposal loss as simple as what? We take this valuation at 23, we minus from it the residual value, the sale value, that 20 million, and that means that we get a loss of what figure? 3.7 million. $3.7 million. Now, what were we told about the disposal profit or loss? Look at note number, let's go back to the question and let's look at this note number 5. What are we told here? That at the end of the project, when the machine is sold, any gain or loss on disposal will be considered for what? For tax. In our case, we are experiencing, remember, a disposal what? Loss. The question says that this loss is then considered for what? For tax, meaning we tax it. We tax it. The next thing that compute is then how much is the taxation on disposal what? Loss. Please remember when you look at note number, note number what? Note number 6. The question had said that the rate on income tax and capital allowance, or the tax rate on income and capital allowance is at the rate of 30 what? 30%. Meaning that as we tax this disposal loss, we shall take the loss which is this 3.7. We now multiply by 30%. And the tax on this loss will be 1.1. Ladies and gentlemen, let's agree. I am doing this thing under period 5. Why? Because we sell the asset in a period 5. So whatever cash flow that comes out of it is there for period what? Period 5. Jeff is asking whether do we tax a loss? Jeff, in practice we don't. In practice we don't. We only tax profits in practice. But then on paper, the story may change. The story may change, yeah? So that when I go back to that note once again, when I go back to note number what? Note number 5. That's what the question says. That at the end of the project, when the machine is sold, any gain or loss on disposal will be considered for what? For tax. So on paper, the question says that we consider the loss for what? Taxation. And what happens is simple. The profits on tax, or the tax on profits, we do pay to KRA. What should then happen on a tax on loss? You know, a loss is the opposite of profits. If tax on profit we pay to KRA, then tax on a loss, we recover that. We recover that from KRA. So this is tax recovered. This is tax what? Recovered. If it were tax on profits, then that would be tax what? Paid. So tax paid, we know is a negative cash flow. Tax recovered is the opposite. It means we more or less receive back this money. And receiving back this money means that one more relevant cash flow here become the tax on disposal what? Disposal loss. And being taxed that you recover, recovering means that you receive back that money, meaning that this is a positive what? A positive cash flow. We'll then have it under period 5, remember, as a what? As a plus. Positive cash flows are pluses, whereas negative cash flows are what? Minuses. And so that is it for that disposal loss and the tax on it. All right. Is there any question on that? Is there any question to that point?
A question?
Yes, this is Meshach. Yes, Meshach.
Yeah, so this tax that's being recovered, are we supposed to add it to our cash flow in the 5th year? Or we don't have to put it there?
Yes, that's what I've done. That's what I've done here, yeah?
Oh, okay, I've not seen it. All right.
I've already done that. Sawa.
So, thank you.
You know, it's a cash flow, so it has to be part of what we are calling the relevant cash flows. Okay?
Yes.
All right. Which other cash flows do we consider relevant? Now, I am still looking at this note number 5, or actually note number 6. In note number 6, we are told, yeah, that the tax rate on income and then capital allowances. The capital allowances part we have dealt with. What does the question mean by the tax rate on income here? Which is this income? Which is this income which the question is talking about? Now listen to this. When we come to this relevant cash flows, one of the cash flows are, we have this sales revenue. And sales revenue means that you are doing business. And actually, the sales revenue has the associated what? Cost of sales, including material cost, the labor, and then the incremental what? Fixed. Normally when you take revenue, you minus the related costs, you end up with what we normally call what? Profits. And such profits from a trade, that we do tax it. And so the next item to compute, working 8, is then the taxable what? Is then the taxable profit on trading. The taxable profit on trading, so how much is it? And then how much corporation tax do we pay on it? Now, I will be computing this for period 1 as very simply. Now, please remember that in this relevant cash flow workings, the revenue is a plus, the costs are what? Minuses. So I can simply add them. The difference will give us the trading what? Trading profits. So that I'll say down here that this equals the sum. The sum of now this revenue and the related costs. I close the bracket. But please remember that one more allowable expenditure that you must minus from this profit, what is it? You must minus still. One more allowable expenditure is this capital allowance. The capital allowance is normally an allowed expenditure against what? Profits. So you must minus it the same way you minus the normal expenditures. And what this will mean is that the taxable profit period 1, we then have 15.5 what? Million. And this will mean that similarly, can we then compute for the other year? So I'll very simply drag the formula to the last year. So that that way, I then have the what? I then have the taxable profit per year. And when you have made these profits yearly, you then must pay KRA, what we call the corporation tax. The corporation tax is, of course, the taxable profit, the 15.5 times our taxation rate, which is 30%. That comes to about 4.6 year one. So drag the formula to the last year so that in the same manner, compute for the other years. Now listen to this. Because this is now profit, the corporation tax we pay to KRA. And so, as part of the relevant cash flows, there will be the corporation tax. There will be the corporation tax that we pay. And because this one we pay, then this is a negative what? Cash flow. So that like period one, this equals a negative, this 4650. So that equals that negative 46 what? 4650. And so similarly, I'll have for the other periods. So that should be a negative what? Cash flow. That should be a negative cash flow. All right, so that's it for the corporation tax. Which other cash flow do we then consider relevant? Let's still come back to the notes. Let's still come back to the notes. And let's look at that note number what? Let's look at note number 7. There is one more cash flow when you look at note number what? 7. And what does note number 7 say? That the project cash flow will require an initial investment in our working capital of 20 million shillings, which will be increased by 5 million shillings at the end of each year to cater for what the question calls general inflation. The whole amount, together with the periodic increase, will, however, revert at the end of the project. So what is this? One more cash flow for consideration here. One more relevant cash flow for consideration. We have the working capital. We have the working what? Now capital. So we have the working capital. That note says, yeah, that note says that the project will require an initial investment in working capital for 20 what? 20 million. Now let's agree. When a question talks of an initial cash flow, and this is very important. When a question talks of an initial cash flow, just like this initial investment, that cash flow only apply for period what? 0. So in the same manner we had the initial investment period 0, we again have initial working capital, now 20 million. So 20 million. That apply in period 0. What about now the periods which follow? The question then says that after the initial 20 million, this will be increased by 5 million shillings at the end of each year to cater for now general inflation. We are then told that the whole amount together with the periodic increase will, however, revert at the end of the project. Before I deal with the reverting thing, yeah, let's deal with this increase by how much? Now 5 million. Allow me to be very clear. If this initial 20 apply in period 0, then it cannot leave period 0. As you then come to period 1 and thereafter, you then only consider the increase. And the increase is how much? Now 5 million. First of all, please let's appreciate this. The working capital is also an expenditure, meaning that this should also be a negative what? A negative cash flow. So that should also be a negative what? Cash flow. So it should be a minus. So when I come to period 1, I now consider the increase, which is what? 5 million. So 5 million. The same increase of 5 million will apply in period 2. This will actually apply to period 3 and 4 also. So initially, they'll pay 20 million working capital. That I've said apply to period 0. In the periods which follow, we then consider only those increments. Only those increments. Now, I have not had the increment of 5 million in period 5. Why? Because the question says that come period 5, this initial one, 20, plus all these increments, plus all of them, they revert in period 5. What does to revert mean? To revert means that we receive back that money. You know, previously, we have been spending this money. That's why it's a negative. In the last year, and by the way, you don't need to be told this thing. Always when you have working capital, at the end of the project, the money must what? Revert. So that we will then have under period 5, the whole of this summation, but then as a what? Is a plus. To revert means receive it back. So I'll have this as a plus here. I'll say that equal to negative first, and then sum equal to negative first, and then sum of all this equal to negative first, and then sum over the whole of that. Under period 5, we then have 40 million what? Plus. If you just add them without putting that minus first, you'll get a minus here. So because this is money that reverts, then I'm saying that that should present under period 5, then as a what? Plus. What other cash flow should we consider? If I go back to the notes, you know that was note number 7. In note number 8, I think note number 8 gave us that issue of demand, which we had dealt with. And then note number 9 was the working capital info. We do not have another cash flow to then consider. And if that is the case, it means we are therefore done. If we are therefore done, we can summarize these cash flows per year. And this will mean that the final summarized cash flow is then what we are looking for here. And let's call it the net relevant. The net relevant cash flow. Let's call it the net relevant cash flow. And very simply what you do is to add these cash flows downwards so that we get the summarized year. So if I add them downwards per year, they total to those amounts. They total to those amounts which I have in what? Yellow. So if you want to compute something like NPV, you know, which was part C, then you'll use these are summarized, now cash flows. But then before that, remember that part B had 15 marks, meaning that these cash flows are which we have summarized here. Let me just color them. That will give you 15 marks, what we have here. Because part B wanted that can we have the relevant cash flows over the project what? Period. Marks given, remember we had 15. Nani yako na swali? So who has any question? No question. So if there is no question, ladies and gentlemen, then we are done with that part B. Now, for me to do part C, I think allow me to push the workings down so that I insert entire row. Insert entire row. I can then say that I have part C. And what part C once we do, we now compute NPV. We now compute NPV. Now, remember the cost of capital or the discount rate to use for the project is this which we had computed in part A. In part A, we computed a cost of capital for the project to be 15%. So can you use that 15%? Then with these cash flows, how much is NPV? How much do you get? I want someone to give me that figure. So how much is it? Yeah, so we do calculate NPV as well. So you say that equal to, and then of course NPV, then you'll have the open bracket. You should start with the discount rate. The discount rate is this which we computed in part A, so that 15%. So I just copy that, and then comma, what follows? What follows is the cash flows, period 1. Remember, you leave out period 0. So the cash flows are period 1 to the last. Then close the bracket, then plus what? Plus now this minus period 0. Then plus now that minus for period what? 0. And this gives us an NPV of negative 12 million. So that gives us an NPV of a negative 12 million. And so that is it for part C. But I think still as part of part C, we were told to also advise on the project viability. Yeah? If our NPV is this negative, what is the advice on the project viability? Is the project viable or not? Which is which? So is the project viable or not viable? Somebody. So in the chat, I can see you all say that this is not what? Not viable. So that is true. When your NPV is a minus, then the project is not viable. The project is not viable, of course, because of negative NPV, and that is it. That is it. Nani yako na swali?
I have a question.
This is yes, Meshak.
Maybe if you can go back to that formula for the NPV. I'm having mine here and I'm getting a different answer.
Meshak, we are doing NPV for the nth time.
Yes, that formula.
Do you have the same cash flows first?
Yeah, they are similar.
You are sure?
Yes, I started with negative 120 and then I finished with 76 million.
So the formula for NPV is equal to NPV, and then in bracket, the discount rate is at this 15%. The one that is computed in part A, comma, you then take the cash flows from period 1 to the last. Leave out period 0.
Yes, I'm having that.
Close the bracket and then plus. Now this 120 minus. Is that the same thing you've done?
Yeah, I've gotten it. I had put, yes. I see. I had put the bracket after the rate.
After
it's fine now. I had put the bracket after the rate.
Oh, yeah, that cannot, anything else will not give you the right figure, yeah?
Yes, thank you.
All right. Nani yako na swali ingine? Okay, so if that is the case, then that will mark the end of that discussion on this particular question. And the reason why I've done this question is to show you that not always will a question summarize for you such a cash flow, and then your work is just to compute what? NPV. You can have sort of a comprehension question whereby you must first of all summarize these relevant cash flows the way we have done it. So you must know how to work out the cash flows before you can get what we are calling the net relevant, which is now what we need for us to compute the value of what? NPV. And so that should be very clear. If that is the case, then I will proceed to, let's open another sheet, and I have the next discussion on, let's have the next discussion on loan amortization schedule. I want something short because we have just about 30 minutes remaining. So the loan amortization schedule, this, I think we can do this in 30 minutes. So the loan amortization schedule. And who remembers this thing? When we talk of a loan amortization schedule, what are we referring to? This also you have done in your financial management. When we talk of a loan amortization schedule, what is this? So I want to believe that most of us have taken loans from banks. And when you make the decision to take up a loan, there are a number of things that you do require that you be advised on. And so such a discussion is what we want to have under the loan amortization schedule. The loan amortization schedule is very simply a table that shows how a loan is repaid. When you've taken a loan with particular terms, how do you repay the loan? What shows us how the repayment is done is what we call the loan amortization what? Schedule. So just note that this is a table. This is a table showing. This is a table showing how a loan is repaid. So how a loan is what? Repaid. And in this context, we are looking at where, tomorrow, if you are currently not, tomorrow you could be working with a financial institution as a loan officer. And one of the tasks you will have is advising clients on loans, more specifically on the repayment of loans. So this topic, of course, is part of this syllabus so that you know how this advice, you can do it. If we are saying that this is a table showing how a loan is repaid, the next question is what is the content? What is the content of this table? I will say that it comprises columns. It comprises columns including what? One is what we can call the period. One is the period, now followed by what? Followed by opening balance, followed by opening balance for the loan, now followed by interest payable on the loan, and then followed by what? And then followed by the monthly repayment, and then followed by the principal, and then followed by the principal, and then followed by the principal repayment, and lastly, you will have the closing what? The closing balance. So as you then prepare this table or this schedule, these columns are the focus. They are the focus. Now, ladies and gentlemen, to then illustrate this, let's look at this example. So that example, I will say that assume an investor takes a loan of shillings 150 million 150 million for a period of 48 months, for a period of 48 months, for a period of 48 months at an interest rate of, allow me to assume 15% per annum. Assume an investor takes a loan of 150 million shillings for a period of 48 months at an interest rate of 15% per annum or per year. Below this, we can say that required. We can say that required. Now, two things. One, calculate. One is a calculate. So one is a calculate the monthly payment. And then number two, prepare the loan amortization schedule. Prepare the loan amortization schedule. All right, so that is the question. It's a very simplistic one in terms of the information I am providing. Now, the first part of the question is that we calculate what we are calling the monthly now payment, yeah? Let's say that we have solution down here. Let's say that we have the solution down here. Let's agree that before I can compute this number one and number two, allow me to summarize the information about the loan. The first thing provided about the loan is the principal. The principal loan taken. And this one we are told is an amount of 100 and what? 150 million. 150 million. Then we are told that the duration or a period, we have 48. We have 48. And these 48 are what months? In other words, the investor should repay that loan within 48 what? Months. Lastly, we are then told that we have interest. We are then told that we have interest. And the interest, we are told that we have 15%. We have 15%. The 15% we are told that this is per what? Per annum, meaning that is for the whole year. Let's agree. Because the repayment has to be done in 48 what? Months. If the periods are in months, then the interest will accrue. The interest will accrue per month, meaning if this is interest per year, can we now get the interest per what? Per month, per month. So we need the same interest, but now for each month. Somebody, when we have interest for the whole year, how do we get the monthly rate of interest? Somebody? When we have interest rate for the whole year, how do we get the interest rate per month?
We divide it by 12.
Yeah, so we take this one for the whole year. This 15, divide it by what? 12. A year has 12 months. And so what you get is about 0.0125. Just leave it at that. You can convert it to percentage if you want, but there is no problem even if we work with it as this 0.0125. So because the interest accrue monthly, then from the interest rate for the whole year, you must get the rate per month that way. All right. Now, after summarizing that information that way, can we now do number one? And number one says that we calculate the monthly payment. So let's calculate. We are calculating monthly, the monthly payment. And ladies and gentlemen, allow me to say this, that this can also be called the monthly installment. This can also be called the monthly what? The monthly installment. One more thing to note about this is that this is what you repay to the bank every month. If this investor takes the 150 million, the question is how much plus interest will the investor be paying to the bank monthly? That's what we are computing here. So just note that this is the repayment. This is the repayment to the bank. This is the repayment to the bank. This is the repayment to the bank by a client. By a client, of course, per month. Per month. Let me say that in Excel, yeah? In Excel, we calculate this. We calculate this using the function. We calculate this using the function. There is a function for it. Using the function PMT. So in Excel, we compute this thing using a function which we call PMT. Now, let's now compute this thing. And so down here, I will say that the installment, this is now how much? Let's compute it. Let's compute it in, say, this cell. How much is this installment? If you want to work with a function to compute this, you will start with an equal sign. every time you're working with a function in Excel, starting point is the equal sign. So these equals are what we want to compute is a PMT. That is the function for it. So you just type equal to PMT, and then you'll have the open bracket. As soon as you open the bracket down there, you are told what the formula should be. That start with the rate. In this case, we are looking at the interest rate. Because we are looking for the monthly payment, then you must work with the interest rate per month. So I will highlight that. So I'll copy the interest rate per month, comma. So you follow that with a comma, yeah? We are then told that we have N per. If you remember in the previous lessons, I've always said that the per is the short form of what? Period. So you follow that with the period or duration, which is this 48 months. So I highlight that 48 months, again, comma, lastly, we then have this principal what? Loan. So lastly, we then have that principal loan. I close the bracket, and then you can press enter. When you press enter, what do you get? That's what you get. And I want confirmation that you are getting the same figure. Are you?
Excuse me, Mwalimu.
This is Jeff. Yes, Jeff.
Could you kindly repeat from where we've started putting the PMT?
So that what I've said is equal to, it's a very simple formula, eh? Equal to PMT, and then the open bracket. As soon as you open the bracket, you should be seeing the formula. Are you seeing the formula down there?
Yes.
Yeah, so you start with the rate. The rate is the interest rate per month, which is this. Because this is a monthly payment, work with the interest rate per month. Then comma. This is followed by the period, the 48 months. And then comma. Lastly, you have that principal loan. And then you close the bracket. Jeff, is that okay?
Okay, thank you.
Yeah, so if you press enter, we then get now that figure. So we have come across this kind of a figure before, yeah? And I told you guys what I don't like about this kind of a figure. What did I say I don't like about this kind of a figure? Eh? I said I don't like two things. One is the fact that it has a dollar sign. Our currency is not in dollars. We had shillings. So you must remove that dollar thing. Secondly, Excel is set in a manner that you get this thing as a what? As a minus. Again, I don't like that minus thing. So I want you to remove it. Remove those two things. Remove the minus and remove the dollar. How did we say that you remove the minus? Double click on the figure so that you go back to the formula for it. What you will then do is before the principal loan, before the last cell, can you put minus? Before the principal loan, have a minus. If you enter, this thing is now a plus. The other thing that remove is this dollar thing. I don't like it also. Also, how to remove the dollar, we already taught. So you come up here, hapa juu. There is this number thing. And then to the right of it, you have that arrow pointing sideways. So click on it. Click on it so that your Excel should take you to the options for it. That's where we do away with the dollar thing. So you are taken to some window where look at the right-hand side, look for that symbol part. You guys know how to do this thing, eh? So look for that symbol part. Click on the arrow that points down for the symbol. And then pick the first option labeled none. So pick none. So I'll click on none, and then down here I'll click OK. That will mean that the dollar has also what? Disappeared. So the dollar has also disappeared. So ladies and gentlemen, remember what we are saying is this. What is this installment thing? If this investor took a loan of 150 million, and the agreement is that the repayment be done within 48 months, if the interest rate is 15% for the whole year, then the amount that the investor will pay to the bank monthly, the monthly repayment to the bank is then this 4.1 what? 4.1 million. And remember, as you then advise a client, if you go working with a financial institution and then you're advising a client about this repayment, once you know how to do this, you can then play around with this thing as much as you want. The investor could, for example, say that this installment is too much for me to repay. Can we reduce the principal loan? So the investor could say that we reduce this loan to something like what? Maybe 100 million. If I change that to 100 million, the installment reduces to this 2.7. So you can then play around with it by changing any of these things now the way you want, the way you wish. You can even change this interest rate because the investor could say, what if I negotiate with the bank and I'm allowed an interest rate of something like 14% instead of 15? To how much does the installment what? Change. The installment will change to 4 million and what? 98. So you can then play around with this thing as much as you want. Just one more thing to note about this installment thing. When I calculate this 4.1, the 4.1 comprises two things. This thing has two parts. Comprises a principal, comprises a principal repayment, comprises a principal repayment, and then the other part of it is of course the monthly what? The monthly interest. So the other part is the monthly interest. So this installment has two compositions. What you repay towards the principal amount, and then the accruing interest per what? Per month. Nani yako na swali to that point? Any question to that point? All right, so no question. Let's look at number 2. Number 2 now wants that we prepare the loan amortization schedule. So the loan amortization schedule. This is now the table that shows the loan repayment. That table that is showing the loan repayment is what we are calling the loan amortization what? Schedule. All right. We have mentioned the columns for it. And you know, we have said the first column is what? Period. Now this is followed by what? The opening balance, which allow me to call the balance brought forward. And then this is followed, just a minute. All right, sorry about that. So after the brought forward balance, we do have interest, the monthly interest amount. And then this is followed by the monthly installment, that monthly repayment. I said we also call it the installment. Now the installment comprises this interest, and then the other parties are the principal repayment, the principal repayment, and then lastly, we have the balance carried forward, the closing balance. So balance carried forward. All right. So those are the columns in this schedule or what? Table. And our periods are 48 months. That means we start from period 1, which is month 1. Period 1, which is month 1. The brought forward balance, remember, is the principal loan taken at the start of month 1. The loan is at this 150 what? Million. I can have my figures here to 2 decimals. So 150 million shillings. And then this is followed by what? This is followed by the interest for month 1. And how do I get the interest for month 1? I say that equal to this brought forward balance times the interest rate for month 1, this interest rate for month 1. So that interest rate per month. So that the interest for the first month is about 1.8 million. 1.8 million. The installment, we know it. The installment is this 4.1 that we computed in part 1. So equal to, I just copy from there. We have said that the installment comprises this interest and then principal. If I want the principal part, then I take the installment, I minus this interest amount. If I want the principal part in this installment, then it is the installment minus the interest amount. That gives me 2.2 million for month 1. How much is the closing balance of this loan at the end of month 1? You get this as what? You take this opening balance, you minus from it this principal repayment. The loan amount, the principal loan is only reduced by the principal repayment. Interest does not reduce principal. So you take the brought forward balance minus principal. The closing balance for the loan is that 147 million and some change. All right, so that is the first month. Remember, you'll always be forced to do for period 2 similarly, so that the brought forward balance at the start of period 2, how much is it? You know this equals what? This equals this closing for period 1. So it equals that closing. So just say equal to, you copy that closing for period what? 1. Can you then calculate these others in the same manner? Now interest, please compute it in the same manner I will do it. Don't do it in another way. So take this brought forward figure, multiply this by the interest rate per month again. The interest rate per what? Per month. Now, does the installment change? Somebody, does the installment amount change? Eh? Do we have the installment changing? Really, Jeff says in the chat that no. So the installment does not change at all. The installment is still the same. This which we computed in part 1. So just say equal to, and then copy that from part what? Part 1. So the principal repayment month 2, again installment minus the interest of 1.8. That's about 2.3. The closing balance for this loan is there for this opening, that opening, minus this principal repayment. So minus that principal repayment, that comes to about 145 what? Million. All right. Now, ladies and gentlemen, my next question is, assuming we are to do this thing 1 by 1 to the 48th month, how long will we take to complete this table? Assuming we want to do, you know, we've done period 1, period 2, we have 48 periods. Assuming we are to do per period until the 48th month, how long will we take? You know, we'll take a lot of time. And take an example of loans like mortgages. You know, mortgages can take up to 30 years. So if you want to do per month for 30 years, that would take you so many days. So we must then look for a way of getting to the last period in 1 minute. We can have the whole table. We can have the table for the whole period within 1 minute. How do we do this? The first thing to acknowledge is which are the constants in this table? What and what do not change? What constants do we have here? We actually have 2 of them. Which one and which one? Which variables in this table do we have that are not changing?
Installment and interest rates.
So one is the installment. One is the installment, and as you rightly put it, the other one is the interest what? The interest, not the interest amount, the interest rate. The interest what? Rate. Now, we have always said that whenever you have constants in a formula, can you do what we have called you lock them? Can you lock them? Lock them. And how did we say that we lock a cell? Let's start with this installment, and you lock them in this period 2. Let's start with the installment. How do we lock the installment for period 2? Now, double click on the figure so that you go back to the formula for it. You know, the formula for it is the cell from which you copied. Like in my case, the cell is D23. To lock a cell, you put the $sign before and after the letter. Like if this is D23, I put the $sign before D. Again, I put the $sign after the D. The $sign is your shift number 4, shift number 4. And once I have done that, I will just press enter. That, so that I go back to the figure I had before. The other thing that we need to lock is the interest rate. The interest rate is part of this interest column. And so I need to lock it in this interest amount. So again, I'll double click on this interest for period 2. But you know that interest has 2 items. It has the opening balance and then the interest rate, which is my cell D17. So what I need to lock is this cell D what? D17. Opening balance, don't lock that. The opening balance changes. What does not change is this one cell, D17. So I lock it by again putting the $sign before D and again putting the $sign after D. Then I press enter. Why am I locking this constant? Because I just want to drag the formula for period 2. I cannot drag until I have locked those 2 constants. So now that I've locked, I can drag that formula. So highlight the whole of period 2, highlight everything in period 2, from period 2 to the balance carried forward, highlight everything. Then you know how to drag a formula from hapa chini. Just long, put your cursor there, long press, and then drag it downwards. Now, as you drag it downwards, look at the right-hand side of your cursor. There is a count, like mine is now at 8. If I push downward, 9, 10, that count is the count for the months. So that you will be dragging downwards as you look for 48. I'll just go down as I look for 48. I'm not yet done. I'll just go down as I look for 48. 48 is somewhere there. And when I get to the 48th month, pay attention to the balance carried forward. So pay attention to that. Remember that at the end of the 48th month, the loan has been repaid fully. And so you cannot have a closing what balance. That balance must come to a plain zero, a plain zero. And so can you confirm that you're also getting the same figure? Yes, are you also getting the same figure? Or rather, have you also done the same thing? Yes, Jeff, have you?
Excuse me, Mwalimu.
Eh.
So when I try to lock the cell under the interest.
I'm
Hello?
listening.
Yes, so when I'm trying to lock the cell under the interest, mine is not there's nothing changing. It's not peaking.
My brother, what I've said is very simple. What I've said is very simple. I have said that when you come to this interest, this one here, double click on it can you go back to the formula for it? And the formula for it is one cell times another. It is this opening balance cell times the interest rate cell. Leave alone this first cell. Don't lock this. Lock the interest rate, which is this 0.0125. And to lock that, what I've done is to put the dollar sign before my letter D, and then after my letter what? D. Then I've entered that figure. I've then proceeded and dragged for the whole row of period 2. I have dragged the formula. So as I drag on the right-hand side, there's a count, like I'm now at 8. So I'll just drag downwards as I look for 48 is somewhere there. If it is not picking, it means there's something you have not done correctly.
Okay, that's fine.
So is there any question on how the loan amortization? Now, this loan amortization thing was set in the last sitting. That exam for August, they had set this thing. Actually, calculating this monthly installment, they had given 3 marks. They had given 3 marks for this. And then preparing the loan amortization schedule, they had given this one 14. They had given this one 14 marks. They gave the same information like this. The same information. The first requirement was that you compute that monthly repayment, just the way we have computed it. And then part 2 wanted the loan amortization schedule. The same thing like we have done here for 14 marks. So this had been set in the last sitting. Actually, this was not 14. This one was 13. 13. There was a part C that had 4 marks. And so is there any question to that point? Is there any question to that point? No question at all. So because of time, I'll be stopping there. When we meet in the next class, I'll start on the next class, remember, is on Thursday. Then I'll start on sensitivity. I'll start on sensitivity analysis. So I'll start on sensitivity analysis when we meet in the next class. So have a good evening. See you, ladies and gentlemen, on Thursday. Asanteni.